Welcome to the Pure Property Podcast. Whether you are considering buying your first investment property or reaching property mogul status, we dissect the fundamentals through to large-scale property development and everything in between.
G'day, hey going, it's Phil Tarrant. I'm the co-host of the Pure Property Podcast with Paul Glossop. Lots of P's today. Going to be peed out because it's happening all over the joint. Back in the studio, Paul. You well? How you going? You brought miserable weather with you today. It's been nice lately.
It was me, mate. It's typically you who brings the foul weather. I bring the umbrella. But
you walk along like, what's that Snoopy character that used to walk around with like a rain cloud above his head?
I do remember that.
What was his name?
Yeah, you're missing me there, but I do know exactly. You just walk and then it disappears, goes under the shade. Yep.
Maybe that's a metaphor for property investors at the moment.
Is it? Okay.
Potentially. You're visualising it for me? What's the lightning? What's the thunder? He sort of smelt a bit, this bloke as well, by memory. Was it Lionel?
It could well be. It could well be. I don't know where they're
Come on, give me a metaphor.
Mate, metaphor for me is probably moved to warmer weather in this time of year when you're down on the East Coast. I feel like it's been a very, very cold June, and actually I think it's backed up by a bit of science. It's the coldest June that Canberra has had. Fun fact. Yeah.
There you go. I think it's chilly down there in Parliament House at the moment. There's not a lot going on. Bit frosty, very frosty at the moment. Lots happening, but very special episode today, Paul. And for those of you who've been tuning in to the Pure Property Podcast for a couple of years, we navigate largely what's going on in and around the news of property investment, give some views, opinions, insights from it, but occasionally we bring in a guest. And guest today has been running around Melbourne for many, many years, probably and all over Australia, competing with Paul on properties. Paul probably putting bananas in his exhaust pipe, trying to stop him from going to open homes. One of the great things about the property investment sector is very competitive, but very collegiate as well. One of the original podcasters in property investment, Bryce Holdaway, joining us in the studio on the Pure Property Podcast.
Thanks for having me, gents. And I just want to say, if I wanted rubbish weather, I'd have just stayed home in Victoria. So New South Wales, I was expecting something better. But thanks for having me on.
You're right. It's even frostier down there, isn't it?
Mate, it gets fresh, but it sounds like not as cold as where you are. But
no, not quite at this stage.
But I'm looking forward to today's chat. The OGs are here, but we're not competitors, Paul. Paul and I have.
You guys hate each other. I know it. Yeah. Well, you're sending barbed SMS to every night. And
as soon as we stop recording, we'll go.
Go
back to hating each other. But no, Paul's one of the good guys. So I've always enjoyed his company. We've had him on our podcast, and I think he's doing some good stuff. And I think that what I love about what the likes of Paul doing, and you've seen a lot too over your time, Phil, is talking to some of the guys that have been around for a while. I think is part of the game plan because we've seen a few cycles, mate. So I think that's I think that helps us with the advice that we give.
Well, maybe I can pick your brains today around what you're seeing out there in the market. But to your original point, the buyer's agent space isn't new anymore. It's been around for a little while, and you guys have been at it for, it's got to be a couple of decades, I would say. I don't know when the launch date of your business would be, but for a lot of Australian investors, they probably just stumbled across it still, and they've probably stumbled across it through some feed coming through their social media, giving them a certain sense of perception around what investing in property is and how buyers agents can support them. So I want to sort of interrogate that a little bit today with you guys, amongst a whole bunch of other things. But Bryce, I first remember you, and for those of you who don't know, Bryce is co-host of the Property Couch alongside Ben Kingsley. It would have been back in the heydays of property investment shows, and you, as a younger, brighter, more bushy-tailed professional, talking about property investment, and you were very good at it. You're probably one of the better presenters I saw in and around property, and that just moulded and morphed into what you're doing today. It's been a good journey for you, mate.
Mate, it has. It started back in I want to say 96 because I'm a Perth boy, and I went to uni. I studied accounting, and I could get to an 8:30 lecture in the morning. If my lecture started at 8:30, I could leave home at 8:19. That's how close I lived, right? So I used to go home for lunch. And back then in the 90s, there was a show called The Midday Show with Ray Martin at the time.
I do remember it.
Remember that one? And so Jan Summers was on it, and she had a whiteboard. She was launching her book, Building Wealth Through Residential Property. I butchered that title, but it's the original Bible for property investors. And she was getting up just on the board, and she was showing how she was buying investment properties. And she said, the tenant and the tax man will pay most, if not all, of your bills. And I'm like, holy smokes, does everyone know about this? And what I didn't know at the time as being young is now doing this for, as long as we have, we know that most of the reason that people don't get into investment property is between the ears. But back then I just thought that just makes so much logical sense. So that was really the start of a journey that made me very, very hungry to find out as much as I could. And I thought, well, I'm going to spend the rest of my life finding out how she's done that, and that's what I want to do. And I just kept that vision in mind. So I went and did accounting. I didn't love it. Full respect to the accountants out there, but just what didn't light me up. And so I started a property business on the side back in 98. And I was earning more part-time than I was full-time with my job as a graduate accountant. So I sort of transitioned into property largely because I was just hanging around with property investors, and, we did it in local RSLs and workshops like that over in Perth. And, even remember those overhead projectors where you had to put it on the screen and flip them out and then put them back in like that. Those were the days. And so that sort of led me on a journey that's been 3 television shows, a podcast, and now 3 books.
So how would you score the career so far then?
I think I've had a fun ride. I think I've seen some stuff. I think when I first got the gig on, the first one was Relocation Australia, but it morphed into Location Australia. I thought it was a dream gig. I got to travel around the country, helping people buy properties, seeing different markets, being exposed to stuff that a little sheltered Perth boy wasn't experiencing at the time, and then being able to build a business with Ben that allows us to serve a community of property investors who want to build some assets and have a lifestyle by design. It's been incredible.
Yeah, I know a lot of property strategists, buyers agents, property investment professionals have seen what you and Ben have created and tried to emulate, and I still think there are people still some way away from emulating you guys. And what you guys have bottled is quite difficult to emulate. It's integrity, it's pedigree, it's time on tools, like all of these huge advantages that you continue to have today. And I know both you and Ben pretty well, and you've always been very open and honest in providing information, education to Australian investors, whereas a lot of property investors, and I would say Paul certainly fits in that same bucket, whereas a lot of property investment analysis hold their cards really close to their chest and have got the secrets and they've got a special system and formula, and they know where to really buy the best properties. I meet a lot of them, and I sometimes question that logic, because the real value of what a buyer's agent does, I believe, is that they help you with the execution. There's bits of it which are hard to do, and one might be finding the right properties, and there's a whole litany of other aspects of it all. But you've been very open, and I think that's certainly your advantage. And I'd like to thank you and Ben for the many years of information being provided in this sector. I know you're highly regarded. And no doubt, Paul, you sort of tuned into these guys, dialed into these guys when you were sort of early on, picking up gems. Just got to listen to them for half an hour, and you're on your way,
mate. It's 100% correct. It's funny. Before, when I knew Bryce was going to come on the show, I tried to figure out when we did our podcast, and I was driving out to watch my boy play soccer on the weekend, which was a long drive out to my old stomping grounds of Western Sydney, because it went from my daughter's game on one side of Sydney to the other.
Did you get excited when you were driving out?
I don't mind it. Once I cross the M5 tunnel and go through down towards the Liverpool and then further down towards what will be Badgerys Creek, it does fill me with. Where he was playing, ironically, was where I played rugby league growing up, and I was like, wow, this park is completely transformed. I didn't know where it was because they changed the name of the park, etc. My point of this story, though, is I had a lot of time on my hands because I was driving. And I listened to that episode.
We met at the airport, right?
We met at the airport in the Qantas Lounge, and we recorded in the Qantas Lounge back in the days. But I was like, you know what? I'm going to listen to that podcast because I got a bit of time on my hands. So I went back, and it was 7 years ago. And I remember, I thought I remembered what we talked about, but it was a little bit embarrassing when you start to hear how you spoke and what you spoke about 7 years ago, because 7 years is a lot of time in life, especially in business and generally speaking in property. But I think the one thing that resonated with me listening to that, which still resonates to me today, and it's probably testament to yourself and Ben's business at Empower Wealth, and also just generally speaking property, and how the metaphor of get rich slow just keeps transpiring year in, year out, year in, year out. We were talking about the property markets at the time, and they were completely different to where they are now, but we're openly talking about them. We're talking about Melbourne was at the end of a big growth market. Sydney was sort of balancing out. It was the leading into the Royal Commission to the banking sector at the time, and all these things that were happening well before COVID was thought about, and everything else that happened after it. You were referring to Perth and how it's suffered over the last 6, 7, 8 years at the time, and lived experience being a resident, all these other things. And it showed me that being open and knowledgeable, but also talking about experiences, talking about past experiences, talking about the fact that none of this is going to happen quickly. It just led me to really consistently motivate me to do a lot similar work in what we do at Pure Property. It's no different, on a different scale, definitely, but it's no different as far as the philosophy.
Yeah, you guys are one of the good guys, and I think so a good friend of mine, Jane Slacksmith, she handed me a book back in 2011 by Brendan Bouchard. It was called The Millionaire Messenger, and my first son had just been born. He was about 4 days old. I had to fly up to Brisbane to do the final shots of the 10th episode of that first season. And I read this book, and it was voracious reading on the way up there because I was just captivated. And at the time, it was saying you need to turn what you know into the expert economy, and you teach that by giving that to people. And the suggestion was value, 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 ask for the sale. So give value, give value, give value, ask for the sale. And I thought, isn't that interesting? So I was marinating on that. I spent some time when my son was born. That year I had off. And I remember thinking, I wonder how we could do this. And then fast forward to meeting Ben, I said, look, I think we should do this thing called a podcast. And he goes, a what? I said, a podcast. And we started having that conversation. But I must admit, I had this, to your point earlier, Phil, I had this really strong sense of insecurity around, if I do this podcast and I share the secrets, we're going to have to shut the doors, right? Because give everyone all the information. What are you actually trading when you have your shingle out the front? And so then fast forward to now, and you guys know this just as well as anyone, that I pretty much say to our buyers agents, the reason you get paid is to get the client to say yes. Now, that is woefully underselling what they do. But at the end of the day, if you can't get the client to take action, they're just going to be one of those other people that are at a barbecue saying a story about the one that got away. Because the reason that we look at photos, like, when we look at photos of our kids when they're young, and I even look at them now, isn't that amazing? I'd so love to go back then. It was so good. And what I'm actually discounting is the fact that at the time, I was full of insecurity and I was full of doubt and I didn't know how the story was going to end. And at the time, I had all these problems. But now I look back, I know how the story ends, right? That's why nostalgia is such a wonderful emotion that we experience. And I think that that's an important emotion for us to tap into, because what happens is, in the moment, someone needs to make a decision, whether it's, you've got a more active approach, Paul, which I really respect. Ours is a very passive approach. There's a number of approaches that you can take. But at the end of the day, if you don't have the strength of mind and the strength of will at the time when everyone is around you saying, are you sure? Do you think that's the right thing to do? Is now the right time? Have you seen what's happening with interest rates? Insert whatever negative sort of narrative that you want to put in there. If you don't have the strength of will at that point in time to say, I'm going to step out in faith despite not knowing what the ending is, you will never be a successful property investor. Because all the people that you've interviewed on your podcast, all the people that we've been, they've got wonderful stories that we look at in the rear vision mirror, but it's what sets people apart is the ability to look out the front windscreen and go, despite the uncertainty, despite the fact that I do not know what's going to happen, I'm going to make a decision, I'm going to take action, I'm going to move forward. And I think that's ultimately what, since doing the podcast and since being insecure about giving away all the secrets, at the end of the day, we tell people the what, and there's a small percentage of the population that will engage us to implement the how. And then the rest of the population will either have a swing at it themselves or not do anything and talk about the one that got away.
The how is the hardest bit. I see it all the time. Property being a love affair for most Australians. Everyone wants to talk about it. Everyone's got some skin in the game or wants some skin in the game, but often they get stuck at that point where there's just too many uncertainties for them to pull the trigger on something. So I think in many ways, and to echo your sentiments, that is the role of the buyer's agent. I personally don't think the term buyer's agent is right. I think we need to work at changing that. Yeah. and me and Paul sort of riffed on this beforehand. I don't know what your view is, but I sort of look at the evolution of this industry, and it's still relatively young, but it's been going for a little while. Sort of your first generation of this industry would be like, and I think you guys may be first gen or second gen, I'm not too sure, but like your Rich Harveys of the world, right? Like really early doors, like, you know, really sort of kicked off. Then it'd be guys like you and the Right Property crew, like real first gen type crew, and then you sort of second generation coming through. So these second generation were all probably clients of those first generation.
There's a lot of that.
You know, I'd say people like yourself, Paul, and Scott O'Neill, all these people I know quite well, you know, who pretty much were moulded out of their experience from this first gen of this industry. And then you sort of had this next generation, which is like your some really good businesses like Investikit, Arjun Paliwell, for example. So that's your third gen, who again were modelled out of the like. But now you've got this next generation. I think it's very, very different. It's very, very different. And I would say that there's this point in time, and with nostalgia, we'll look back to this point, I think, to your earlier remark, Bryce, and say, this is when this industry went the right way or the wrong way. And I'm going to say it's a real inflection point for it right now, because the equity of professionals that we have of those first three generations, I think, and these generations move quickly, right? These aren't decade-long generations. They're so immediate these days that this next generation coming through needs to certainly be counselled on what the view of what property investment professions is moving forward. Because my fear is, and I like your comments on it, is that the profession may be eroded from this business that we're in. I don't know if that's fair or not. I don't have a view, Bryce.
Yeah, I think there's two categories too for that. So first of all, the sentiment, I agree with that there is a wave coming through that. I agree with this sentiment. So when I was first starting back in the late 90s, we used the term the enthusiastic amateur, right? Where people would come in and they would just love the idea of creating wealth and buying property, and their passion was real estate. So their heart was genuinely trying to do the right thing. They were just amateurs, and they hadn't been through cycles, and they didn't know what the end result of what they were saying were. And at that time, it was getting people into off the plan and house and land estates. Now, what that's evolved to is, I think, the likes of the three of us in terms of our podcasting content have really helped change the narrative in the marketplace, and people understand the difference between what asset to buy now. So that's probably well and truly documented. But now what we're seeing is the proliferation of silver bullet strategies, which is a new breed of enthusiastic amateurs who are actually probably still in the, playing in the right space in terms of probably playing established versus new. But they're taking people into very high risk strategies where they get one client in at this entry level, and then they get the next client in, and then the next client in, and then by the sixth or seventh client, the first person's got a 29% growth result, largely because you can actually influence markets, particularly small markets, through buyer's agent activity. And so if they do that pump and dump strategy and then use the 29% growth as the marketing strategy to get the next person in, one of the clients did get 29%, but the last person in the queue didn't. And so that means that a whole bunch of people are being enticed by very, very clever marketing. We call them finfluencers, who are very, very good at getting people's attention. And so I fear that the training that is being offered to get new entrants into our marketplace is focused more on how to get a client than to actually deliver the actual execution of the product that you're there to do.
Yeah, I agree. And you've got to remember, it's completely unregulated, this industry. And hopefully in time they'll work out how we can actually put a wrapper around this industry. And it's still relatively young. It's still relatively new, but I'm concerned.
Yeah, you should be. And
I'm concerned. And this is me as an independent, impartial person without bias or agenda or fear of favour, other than I want to ensure that the Australian consumer, i.e. the property investor, gets the best results they can. But to your point around the silver bullet strategy, I don't know if you have a view on this, Paul. I hosted a intimate roundtable of property investors the other day. over dinner, and it was a good discussion. We had lots of chats about stuff. I won't bore you with that, but one of the participants on the round table said to this person who was on it, who you would know. Okay, we get all the stuff that we hear from all of you all the time on how to get rich slow type stuff. What are the strategies, where to buy, diversification? He goes, but give me something that no one else knows. Just give me something. Give me the what you don't say to anyone else. Just so and this person really explained it. And they got down into some of the real deep minutiae of trust based stuff and how you can use it. And I made the comment to the guy. I said, that's all good. And I said, anyone that tells you some secret that no one else knows, run to the hills, mate. That's what I said to him. I said that there is property investment. It's not rocket science, pardon the phrase. Like, there's basics and there's fundamentals and there's more sophisticated strategies around it, but there's no real secrets. Like, and if someone's got a secret, I don't know. You got lots of secrets, Paul. I won't ask you what they are.
Not property related.
That's a fair call, right? Like, that's a fair call.
Absolutely.
Is there anything you ever hold back?
We've been doing this for a long time, Phil. I think we've been talking over microphones for a decade, and in that time we've talked about probably every market in Australia, and not in the sense that we're trying to refer to where and what to buy or avoid, but ultimately we go through data, we unpack it, and we say, here's what's happening. Here's what we expect is going to happen over the next 12 months, 3 years, 5 years. And you do this long enough, you do see the clues become a lot more obvious the more you look at trend lines, the more you look at all the broader data, and you can package it by typically a 4 or 5 paragraph page. Sometimes now I can look at it on a quarterly basis, and I dare say you guys are doing the same thing, where you're not trying to think, okay, where's that market going to be next quarter? That's irrelevant for me. But when it comes down to trying to assess something, we put a lot of effort into the Fast 50 guide for the last few years, and the intention of that is not trying to get people to try and think about how they can make a squillion in 12 months, but it's trying to really unpack all of the different things that go into assessing markets and data, and then saying, here's all the info, here's where we expect is probably going to outperform the rest of the market based on all these factors. Go have a read of it. There's every single suburb that we think is going to be available in there. They can go download it on your website today. Now, the reality
Smart
is...
property investment. Quick plug.
I was going to say, there's 3 websites we're talking about here. But I think the way we look at it here is, I mean, I want to be, and we do want to be catching up with clients who bought in a market 5 years ago, 7 years ago, 10 years ago, with the intention to say, okay, well, we bought that property for that outcome in that time. Along the way, we'll catch up. There might be some more speed that happens out of that growth cycle. There might actually be more sideways movement, and we might have to be a little bit more patient, all those other things that we go into. But the reality is, to your point, Phil, is that if we're talking about secrets and markets that have secrets, typically the markets that might be under wraps or under a cloak and dagger scenario are probably going to be very small markets. And to your point, Bryce, is that if a market's very small, it actually can be very easily influenced. And that's also the very big risk here. I think that's something that, although ultimately, inherently, a market that's small typically is not a major capital city, nor is it a major regional centre or a top 20 size market in Australia. So you do have to be very careful that if you're being recommended a market to buy in, which is a market that you firstly don't necessarily know very well, and secondly, you're buying for a 10, 15-year outcome that could be very easily influenced by 30 or 40 or 50 sales in a year more than what the normal averages are. That for me is a much higher risk strategy, and that's probably what we're seeing a lot more as far as a theme in this 3rd or 4th generation of buyers, agents or advocates that you mentioned earlier, Phil, and also what you're mentioning now, I think, Bryce.
Yeah, in the book we talked about margin of safety, and there's a quote that everyone's got a favourite Warren Buffett quote, but this one was one that I hadn't heard too often, that he said, if you're driving a 9,800 tonne truck and you're about to cross a bridge that's 10,000 tonnes, he says you probably should just go up further into town and find one that you can cross that's 15,000 tonne, right? So I think some of that really encapsulates the message that Ben and I have around margin of safety, right? We want to go where the assets are going to perform over decades, not months. And sure, if people are running around chasing short-term spikes and they are traders and they are more active, fine. And some people are doing really well. There's some outliers in this country that the 3 of us know that are absolutely slaying it. But they are outliers for a reason in terms of mindset and time available and skill and knowledge and application. But for me, I always just go back to, and we put it in the book, there's the stats, and we read it out on a podcast recently, the most recent stats, which we didn't have in time for the book. was that the majority of property investors stop at 1. 71% of property investors stop at 1. And if people just let that land for a minute, and 2 is 19%. So between 1 and 2, it's 9 out of 10 property investors don't go past 2. So if that's the case, most people aren't doing the outlier stuff. So therefore, what I would prefer to focus on is most people do cash flow patterns of middle-class people where they use their income to buy liabilities to pay their expenses and it goes out the door. Well, if we can just get them to redirect some of that money during their working life towards buying 1 or 2 investment properties combined with their super, we've got 7 case studies at the back of the book show that how you can retire on $3,000 a week without betting the farm and doing it passively, not actively. And I know, Paul, you're successful and an advocate of active and you're very good at it, but a lot of people aren't. And a lot of people aren't prepared to do what you're prepared to do to understand that side of it. So a couple of properties, combine it with your super, $3,000 a week.
Well, I want to get into the book, but before we get there, it's sort of connected with this discussion, just to round it out. How do both of you not get deviated from the core of what you're trying to achieve? So it's easy for all of us to be influenced by the noise that you have around you at the moment. You see the stories on social media, the next big hot shiny spot or whatever it is, right? It's easy to get distracted. How do you sort of stay the course for your clients specifically?
I think the way that we stay the course is by reminding ourselves that we are agents for other people's money. So it's one thing for the 3 of us to go, I'm going to go and do this, I'm going to go and take this particular path because I'm putting my money at risk. But when you're an agent for someone else, you've got to take that responsibility enormously, right? So Ben and I take that responsibility. We do not take that lightly. And so we also have been investing. This is our 3rd decade that the 2 of us have been investing, right? So we've got a lived experience. Yeah. It's an overflow of our own experience where we go, we've seen them come and go. And we've seen, there's not, to the point before, there's not too many secrets. There's not too many things that surprise us anymore, collectively on this table. But just knowing that for the majority of people, they don't invest in property. For the majority of people, they will end up in a middle-class lifestyle of spending all their money, relying on some form of super at the end, and then realise that that's not enough. And we're not called to serve the outliers. We're called to serve the majority, the 2 million property investors who are playing the long game and they play the decades game. And it's one of the things we put in the book. There's a graph that we put in there on page 61, which is effectively showing if you buy a $700,000 property and watch its journey over 30 years, it ends up being over 4 million, right? Most people go, that seems absurd, but all you need to do is look in the revision mirror. But what I think is more compelling than just going, there's another table of 6% growth on a property. Like we've all seen it in every book. What's really compelling is in the first decade, it's about 13% of the 30-year growth. In the second decade, I don't have it in front of me. I should get it. It's
Here we go.
20-odd% in...
He's been itching to pick the book up to tell us all about it.
Here we go. 17% in the first decade, 30% of the growth in the second decade, and 53% growth in the third decade. So the point of the story is the majority of the benefit comes from actually staying in the game for a long time, right? Most people don't realise that Warren Buffett's wealth is largely done after his 99% of his wealth is done after his 50th birthday. They all try and work out exactly what it is that he's done, but
he's lived a long time.
The answer is right there in front of us. It's time.
That's a big part of the job. It brings me to one thing, and to your point, Phil, and I think exactly as you've outlined there, Bryce, is probably if I look at what concerns me as a business owner who is also responsible for people's decisions in money, and they do follow. I mean, ultimately they're engaging us to give advice and execute on outcomes which they're potentially not having the time or the propensity to achieve themselves, is you have to understand when and what we want to position people's money in, not for a 12-month outcome, but for a 10, 15, 20, 25-year outcome. Now, whether that gets traded earlier because there's been better growth and there's better opportunity, separate conversation. But it is probably the thing that I concern myself outside of the normal business operational side of things in general, that is something that I take, and my team, I know we have very detailed, regular discussions about how's the market tracking? Is it moving far too quick? And I can think of 4 or 5 scenarios over the last 5 years where we've seen rapid movements in many markets that we've been in. And no doubt you've been the same, mate, where we look at it and say, are we buying at a point in this cycle now where I'm not super comfortable where that's going to be in 5 years? And alternatively, the other side of the ledger, are we too early here? And are we going to be having a conversation in 2 or 3 years' time where we said that money probably shouldn't have been in there that soon? But when it comes down to why are we buying and what are we buying for, we're not buying for that 2 or 3 year time frame. And I think if we're comfortable that, hey, that is not the mantra here, that is not the objective, then the rest of it will work its way out, to your point. And it actually led me to, there's a relevant thing that happened. The Lakers, LA Lakers sold recently, and I saw a quote that blew my mind, and I had to fact check it because I thought that can't be accurate, where Jerry Buss bought the Lakers for $67 million famously back in, I think it was 79, and his daughters recently just sold it for circa $10 billion. And the quote was that if you took that $67 billion and chucked it into the NASDAQ at the time, or sorry, not the NASDAQ, the S&P 500, that it actually would have outperformed that result in that 46 years that Jerry Buss bought and his daughter sold the Lakers at 11.5% compounded over that time, but works out to be about $11.5 billion unleveraged. And I started to do all these other numbers. I think, imagine you leverage that at 80% into property, and I started to work backwards, and essentially I was like, wow, what looked like one of the best sports business plays on paper, on record, actually would have been achieved across property, across ETFs, across index shares, across a range of things. And you think, wow, you can make significant amounts of money.
But you'd have to caveat that with assuming that you kept in the market during the whole
this
period
is
of time.
The point, is that 46 years, that growth came exponentially.
If you missed a couple of marks on
that's
S&P.
Exactly right. And they talked about the valuation of the Lakers and how it trended, and majority of the value came in the Kobe Bryant, Shaquille O'Neal era, and then the LeBron James era, where the exponential value kept increasing, and ultimately turned into something. But majority of that growth happened in that last 10, 15 years in the valuation of the company. But so it did too if you sat in the S&P, if you sat your money leveraged in property. And they're the types of things which you have to be comfortable and confident that. And the reason why superannuation is such a powerful tool in your 50s and 60s, as long as you invested there, because the majority of the money's made in your superannuation in your 50s and 60s. It's not made in your 40s or your 30s or your 20s. And hence why the compounding effect is staying the game as opposed to the returns you're getting in any particular year.
So I've got a bit of a beef.
Only one?
Today.
Okay. Yeah, which one?
And there's a whole bunch of people out there telling me that I can retire with $150K a year passive income from investing in residential property. Mm-hmm. I go, nah, can't do it. Can you?
Well, I've written a book about.
I know, it's
that,
surprising.
so
Here it is here. How to retire.
I think you'd be surprised if I say no.
How to retire on $3,000 a week. The Property Couch's playbook for passive property investing. Now, I'm hoping you've got the secret sauce in here. I've flicked through it. Looks good. I've read bits of it. I go, yeah, that makes sense. No doubt everything would have to be prefaced with time, which we've just spoken about. Well, but tell me how you do it.
100%. So none of them in the book get aggressive. There's no renovating. There's no subdividing. There's no development. It's all passive. So it's largely around, because to Paul's point there, you are dollar cost averaging into the investment market already, right? Just by nature of working in this country, because you have a compulsory superannuation scheme, which is going up to 12%. So that alone, that compounding of that increase of that super is actually going to do enormous things for people anyway. So we're saying if you continue to buy your home and pay it off, you continue to contribute into super, and you buy, typically for most of the case studies at the back, 2 investment properties, and then have a journey to retire out the debt by the time that you finish your working life, combined with your super, the $3,000 per week passive income is available to you from your portfolio and your super. Now, we have got some case studies in the back with a single male rent investor and a young professional female. They don't have 3,000 in the case studies. One has 1,700, one has 1,600, and that's because the $3,000 a week is for two people, which is an average of $1,500 per person. So for the single people, they still beat the run rate, right? So to answer your question, Phil, I think that if people start with a very clear North Star and they put some planning in place, including putting the big rocks in the jar and scratch itches that people want scratched, which is, well, I do want to upgrade my car every 10 years. And there is actually an overseas holiday that I want to do. And I do want to take a sabbatical in 3 years' time to go and learn or travel or whatever. If you do not treat property investing exclusively from real life and you merge the two and then you build a cash flow plan to do that, I think it's possible. It also relies on you being able to resist the urge to spend more than you earn, which is, it sounds pretty easy on paper, and our grandparents would, turn in their graves at the thought that the current generation doesn't do that by default. So there's some basic money management principles that you need to have in place, but there's nothing in that book that you will read that is overtly aggressive, that is not conservative in nature, that is not available to people who are willing to take action, delay gratification, and lift their eyes when negativity strikes. And that negativity can be in typical sources through the news feed, but also just friends and relatives and well-meaning people who bump them off guard. Because I promise you, the alternative is you stay middle class, you continue to increase your expenses at the same rate as you increase your income, and then you'll get to retirement and realise there will not be enough.
So you've got 388 pages and you've articulated very well to give you a pathway for achieving that. I guess where my beef lies is, it's not you guys, but these numbers get bandied around really flippantly around sort of social media and other outlets where they just go, I'll show you how to build a, passive property that does whatever. And I look at the market right now. If you're starting today to actually get to $3,000 a week, you're not doing that in 5 years. You're not doing that in 10 years, unless you're hyper aggressive or your risk appetite is very different than the norm. So I think the important thing is it needs to be tempered, the fact that you can achieve this, but it takes a long time. And you're talking 30, 40 years. And a lot of people are dismissive of that. They go, no, I want it today. And this is probably the biggest challenge property investors are going to be facing into the future.
Yeah, I agree. And the devil's in the detail, right? Because the challenge that building out a roadmap of achieving that is that for a lot of the discussion, you need to be talking in future value, right? So that cup of coffee that you're drinking now is cheaper today than it is next year, than it is 10 years from now. So being able to factor in future value into present value is actually not that easy to do, right? And so most people can do a spreadsheet that goes out for 2, 3 years. But when you start trying to make decisions in 10 and 15 and 20 years, and you're making decisions around building a portfolio that will be purchased in future value, that'll be financed with a future loan, that'll be financed with a loan to valuation ratio in the future, not now, those are very difficult things to be able to coordinate to get that right. And so to your point, I think a lot of the, to use your term, the fourth wave, the fourth generation of advisors, they're not factoring that in, and they're having quick wins on basic spreadsheets that factor everything only in present value. And so therefore, I would argue that the baseline that they're making those recommendations is on a work of fiction.
And therefore it comes back to the investor themselves. And I'm one of the biggest proponents of using smarter people than you to help you, craft out a positive wealth creation journey through property. But you still got to pull the trigger yourself. You're still responsible, accountable. To your point, a $1 million property today may be worth $4 million in 20 years' time. This cup of coffee, which costs $5 today, might cost about $15 to $20 then. You still got to pay the bills. So $3,000 a week in ... years' time, it's, again, putting perspective to it, you're not going to be Lord of the Manor on that sort of dough. It's going to be a very, I would say, considered, and I hate to use the term average retirement, but that's what it is. But that's the reality for most people.
Can I give you an alternative bone to chew on there? Because $3,000 a week, just for the record, is purchasing power today of $3,000 a week. And it's also something that I don't think a lot of people think about is your expenses during your accumulation phase right now come into 4 categories. You've got discretionary spend, you've got bills and spending, you've got loan payments, and you've got, if you're building investment, you've got portfolio costs. So there's those 4 things. But if you've done it right, when you retire, a lot of people go, $3,000 a week? That's not enough. I earn way more than that now. I'm like, okay, let's break that down. When you hit retirement, you know if you've done it correctly, you don't have a mortgage anymore. If you've done it correctly, you should own your cars. If you've done it correctly, your kids probably are fully independent. So those are major expenses that you're accounting for right now in your budget that you won't have to back then. So imagine if you didn't have those expenses now and you had $3,000 a week now, what difference would that make to your lifestyle? And people start to go, actually, that would make a material difference. The cash flow that would be flowing through my house would be significantly better. And we're like, exactly, right? Now, some people come to us and they say, 3,000 is not enough. We want 5,000 a week. We go, well, if you have the income and the resources, let's go for that. Other people come in and say, we have someone on the podcast. She wanted $30,000 a year to live, and her expenses were less than that. So she, by getting 30,000, her expenses less than that, would be wealthy by definition, because passive would exceed expenses. So the spectrum, and I write that, Ben and I make a very strong point in early to say that it's whatever number you want it to be. It's obviously a hook. It was the previous book said 2,000 a week. It's now 3,000 a week. So it lasts another decade.
But that's $3,000 a week today, and equivalent of that, whatever that is in 20 years' time.
So we project the future value of that so that it has meaning for the person picking up the book today.
So realistically, how long does it take to actually create what we would deem, and most people would deem, a pretty comfortable retirement? How do you get this?
For the majority of people, it's their working career.
Okay.
They go through their working career. So at the end of their working career, they are in a position to say, I'm not going to be on the pension. I'm going to be a self-funded retiree, to the point where I do not have to rely solely on my superannuation capital base that will diminish over time, because if I've done it correctly, I've paid down the debt on these properties, I'm getting the passive income that will continue to grow, the rents will continue to grow over time, and if we've done it really well, we can pass that on to the kids.
Okay. Would it be fair to say that if you're listening to this podcast, that would be, if you're of the age of 30 to 40, that would still apply to you, or is that considered, at what point would you say, hey, that's too late, or hey, you might need to make some concessions or some dramatic changes to the way things are on their current cadence? Let's
lie. We just talked earlier about time being the secret sauce. So the later you are, or the closer you are to your retirement age, the more you will need to think about how aggressive you need to be to still be able to achieve that. But it might mean there's spectrums then, because we could go, well, for us, the nirvana is that you hold these assets in perpetuity through your family tree. But for some people, if they start later, that might not be the case. They might have to go, hey, listen, we've only got a decade in the game, and so we have a divesting strategy. That means once our super starts to diminish, and then we have to rely on the property.
Hopefully they're still relying on the podcast. You guys got to be podcasting in 20 years? Yeah.
I'm not sure about that. But,
I think AI might be doing that for us.
If not already. Is this really us? So they may have to start selling down and getting to the later years of retirement where they don't have their own assets. So, like, we're not going to sit here and lie that it's not the earlier you start, the better. But also, the number one question we get is it too late to start? And for the majority of people, retirement age is going to continue to get pushed out based on the fact that we can't afford to give enough money through the government for the people, so they will continue to push that out. So you're going to be working that time anyway. So our theory is
get used to it.
100%.
Get used to work.
Inaction costs a lot. Ultimately, as well. I think for me, that's what resonates always when I read something that is essentially focused on, hey, you need to get busy and you need to stay in the game. Time is your ally, and I think we talk about it so often. But those who take all the information and are the ones who talk about it at the barbecue, that was what I was thinking about doing.
Can you guys give me a sense on whether or not you're the sort of merchants of disappointment when you chat to clients, or you're actually invigorating and giving them a perspective they wouldn't know? Do most people think this is possible, and you go, mate, that's impossible? Or most people think it's impossible, and you go, no, it is possible?
I look at it personally that I know if I've got a meeting in my calendar with a potential new client, that they're the action takers. We're not trying to spruik to people who are trying to listen to a message which they're not necessarily convinced on. So I think the beauty about speaking to people who proactively reach out to us as opposed to reaching out to people and say, hey, do you want to have a chat about it, is that these are people who are already convinced themselves that they know they need to take action, whether it's the first step, whether it's the fifth step. So most of the time those conversations are more encouragement and, yes, you're considering doing the right thing, let's keep going. Or
But do they overcook or undercook their expectations?
The expectation part, that is the part where I find there is a sliding scale that the younger the person is, probably the less realistic they think is going to be what they can achieve. However, I think they also, to your point earlier, Bryce, I think they're way overcooking what they actually need to be happy and satisfied and content in life as well. And that's probably where I see that segment or that bell curve goes, that most of the time the people who are realistic are typically they've lived a portion of their life, they know what's important to them, they know what they need to be happy, they've done some form of budgeting, etc. And then the ones at the end sometimes are the ones that make me probably the most nervous, who are the ones that maybe have taken no action and are maybe within that 10-year horizon, and they come with the expectation that they need to make it all happen in a quick period of time. And they're the ones that, going back to those third and fourth generation buyer's agents, so to speak, that's when I get really scared personally, is that if they go to that, hey, here's a silver bullet strategy and you'll get to that outcome in 7 years, that'll coincide with retirement. They're the ones who I think are risking it all for a very, very slight chance of an outcome there.
Yeah, I think just to add to that, we make the invisible visible, right? Because there's only 4 levers: time, target, income, and expense. And so when we expose that to someone and show them what that looks like, well, then sometimes we are the family planning clinic. They were planning on having 3 kids and they decide after having a chat that they're only going to have 2. Or they were adamant that they were going to send their kids to private school, but they realise that their house will run insolvent if they do that. So they've got a choice to either send the kids to public school or invest heavily in their biggest wealth creation tool, which is their income, and try and find a way to get more income. So what did you call them? Merchants of doom?
That's what I called you guys.
Maybe sometimes. So we'd like to think
Merchants
we're
of
the
misery.
voice of reason.
Buyer's agents need a new terminology.
Maybe that's what I am. Maybe I'm the guy.
Change your business cards.
We like to think we're the voice of reason, don't we?
Voice of reason and
I like to think it's a
sensibility.
little bit more upbeat than a merchant of doom. Jeez,
But it's all out there. So, mate, this is a real book. It's like I can feel it, hold it, read it. I'm a big book guy, by the way, and thank you for the personalised note. I really do get a kick out of it. And it's just not you. I know Ben Kingsley probably did 10% of this book, but
no, he'll tell you he did 90% of it. No, but it's definitely it's our life's work. We spent a lot of time together framing it up in a way that we think makes it super easy for someone to start at the beginning, and by the time they get to the end, they can do the thing that we think that Ben and I are here called to serve, and Paul as well, is to get people to actually take action. And if we can present the message in a way that doesn't confuse them, empowers them, and makes them feel full of optimism that they should take a positive step forward, I think that's a win. So I'm really proud of it. I think it's, Ben and I combined 40 years in the trenches, and I think that we've curated the information in a way that for someone who just wants to make sure that they avoid the number one regret that people have in retirement, is that they start to panic they don't have enough money. If they pick up that book in a weekend, by the end of that weekend, we feel really strongly that they'll have a plan that won't take them too far out of their comfort zone. Do they got to do something that's different from everyone else? Yes, they do. But we're not asking them to bet the farm.
Well, what I like about this is, Paul, you've asked Bryce to come onto your podcast saying, hey, read this book, because it gives a sense to how collegiate this industry can be. We all operate in it and doing our specific things, but the better the education, the better decisions people will make. So, how to retire on $3,000 a week, the property couches, play for passive property investing. And I'm surprised you haven't gone, but I've got a book as well.
That's not for this podcast, mate.
Well, it's a better book, by the way.
It's heavier.
It's heavier. It's got more pages, thicker stock, more graphs
think
and
about
charts.
the cost if you put it in your luggage on your travel.
I know. That's what you need.
Excess
That's
weight.
What you need.
No, we had Paul on our podcast for a reason. Ben and I have got our competitors on the podcast, but we curate the ones who we think have the core fundamentals within their own business that we can feel comfortable. If someone comes, people are going to come into our podcast, they don't resonate with me and Ben all the time. So they'll listen to someone like Paul and go, yeah, we'll go to his business because he's one of the good guys. So
you guys often still sort of would say, hey, I'm not right for you. You should have a chat to the guys over at Empower and vice versa.
Yeah, I think I could think of literally dozens of people vice versa that might have sort of have a tendency one way or exposure another way, or just generally, that they want and probably need something that might be slightly different. And no businesses are alike. And I like that because we genuinely aren't the same as the next buyer's agency, and we don't include or exclude certain things of what we do as part of our entire service. And I know within Empower's team, there is things that they do that we don't do, and we don't necessarily have intentions of doing because it's not technically what our business is really focused on trying to do, and vice versa. So that's a big reason why.
So while I got you here, Bryce, but we remiss me not to ask you this, where should I invest right now?
Look, for me,
here we go. Read the book. Available in all good bookstores.
Well, what I don't like, I take it. I honestly get asked a number of times where I think people should invest, and I decline all the time.
Yeah.
Largely because I think there's good opportunities everywhere, which is the most vanilla and boring answer you'll get. But I think more people should spend more time worrying about paper trading their life up front and then worry about where to buy later. I think too many people want to chase hotspots. But look, I think if Australia is largely East Coast driven. I'm a Perth boy, as much as that breaks my heart. We're East Coast driven, and right now there's value in the north. So if you were putting a gun to my head, I'd say put some money into the Southeast Queensland market.
Yeah, and I expect you to answer the question that way. It's the right way. And so people ask me all the time. I go, I don't know. How am I supposed to know?
Yeah. I'll tell you where we are buying. We're buying in Perth. We're buying in Melbourne. We're buying in Geelong. We're buying in Brisbane. We're buying in the Gold Coast. We're buying in Adelaide. So
pretty much everywhere.
How does that help?
Yeah.
Right? How does that help? Other than for the person we bought in Adelaide, that was ideal for them based on what they presented to us.
Yeah, and that's the game. But mate, thanks for coming in. I do appreciate it. Thanks for getting Bryce on as well.
No, it's a pleasure. I'm glad we could make it happen at very relatively short notice.
Have they given you a little?
Not yet. I expect it'll be somewhere.
That'll be
that'll be something.
That'll be coming.
I'm sure they've got some books here. But
well, it's because you were kind enough to give us a little.
I know.
I
thought I was special. I'm one of about 100.
Mate.
And I'm sort of last.
Mate.
I thought I would have been number one. I see. You got the who's who here, right? Like, to be fair, you've got some of the great minds in and around property. Peter Koulis. You've got Effie Zos. Nicola over at Pippa. Victor Kumar.
Yes.
There we go. He's Damien Collins. Empower. Scott O'Neill. These are all the people we spoke about.
Yes.
Yeah, that's good. Well, I think everyone's appreciative. Thanks for sharing your knowledge. I've started getting through this. I must get one property book a week.
I was going to say,
sent to me.
Yeah.
But I've read probably 3, and this will be the 4th one I'll read. So, because then what I'll do, I'll just regurgitate all these ideas, make them my own. So I sound really smart. No, but thank you. How to retire on $3,000 a week. I know I saw it in the airport already. It's out there, so go and buy it. Don't wait till it ends up in Target, a discount bin. Get it now, because every day you waste is a day further away from $3,000. Oh. No, giving you a hard time, but really good. Thanks for sending through, Paul. Good to see you again. This is the Pure Property Podcast. We didn't talk much about Pure Property today, which is good, but really good insights.
Other than they are the good guys, so I'm happy to endorse that.
One of. I'm not endorsing anyone. I don't endorse. I just.
I'm endorsing Paul.
You can endorse him. You're allowed to endorse him.
We're all endorsing everyone.
You're professionally qualified enough to actually have a peer review.
Paul's of great character. Yeah. I can't tell you about his business, but I know him as a human. I can endorse him.
Well, if you want more about Pure Property, go to purepropertyinvestment.com.
That's the one.
Ooh.
Check it out. You can have a chat with them. But thanks for everyone tuning in or watching this, wherever you're watching us. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.